Huh.
Welcome, everyone. My name is Jamie Vilsbach, and I support the Colorado Small Business Development Center in the Central Mountain region. And I'm glad that each of you have joined us today. You're attending our profit driven series. And next slide, Billy. The Colorado SBDC assists in a variety of ways. We help small businesses, whether you're starting, you're scaling, you're growing, or you're exiting, with no cost confidential advising, as well as low or no cost workshops and events such as the one today. And we assist with access to capital, and we do that in a variety of ways. We help you with lean business plans, as well as financial performance. And then we do introductions and give you a lot of other tools and resources. So, with that, next slide. I wanted to make sure you knew this is a part of a 7-part series on financial training, and we have one every week, and then they will be recorded and offered on demand after the fact. And after this session, we will send out the slide decks as well as the recording. Next slide. With that, it's my great pleasure to pass it over to Billy Marquise. He's the founder of Marquise CFO Advisory Services. And he will talk more about his background, but he's a CPA and a seasoned CFO. And I have to say, he spoke at our We Gather series, and I was just in awe with the scope and the depth and the clarity of his training workshops. So, welcome, Billy.
Hello, thank you for that nice introduction. Appreciate that. So, yeah, we're going to go through a little presentation I put together. And first, I'm going to start off with just who I am. I'm an accountant and a business owner. I do have a CFO practice as well as a seasonal tourism-based business, Arkansas River Tours. Um, So I use my financial background to help business owners have a growing and more profitable business. And I'm successful at this because I understand both sides, the financial side and the business owner side. And as an accountant, I'm able to look at the business and really spot underlying issues, why it's not profitable, maybe why it's profitable, and potential issues with cash flow. And more importantly, I do know how to fix it, and I know how to help businesses grow and become more profitable. So really here, I'm just on a mission to help business owners to have a growing and more profitable business. All right, so to get started here, I'm gonna go through our agenda. The first thing is why most businesses fail, the difference between a business that's a machine versus a business that's a job that you happen to own. Right. And then 3 sources of money for every business, how to get control of time and money from your business, why most business owners make less than 100 grand in income, and the 16 drivers that drive revenue, profit, and cash flow in every business. And then just a little housekeeping. This will take about 45 minutes, and we should have about 15 minutes for questions and answers at the end. And then, yeah, if you could just put the questions in chat as we go, and then we'll get to those when we're all finished up with the main presentation. And then I can send out an email with contact info afterwards. So, and then, as you know, it's recorded. Okay, so we'll get going here. Why most businesses fail. So most businesses fail. In fact, 20% fail within the first year, which is pretty staggering. 35 fail within the second year. 50% fail by the 5th year. And here's a little chart to kind of show that. This is from the US Bureau of Labor Statistics. So kind of staggering facts here. And if you think about it, 1 out of every 2 businesses are gone by their 5th birthday. All that time, energy and money gone. All those hopes and dreams of the owner gone. All that the owner is left with is a ton of debt and realization that they must go back and get a job. So the reason why most businesses fail, they've lacked the money. Every business would still be a business today if they were able to have access to money. And so I'm going to kind of talk about money here a little bit, but it solves everything in a business. So if you have a marketing problem, money allows you to do more marketing or hire better marketing professionals. If you have a management problem, money allows you to hire better managers, maybe more managers. So you can start working on managing them versus managing the business. Um, Having a down market, money allows you to weather the storm. A seasonal business, I'm very familiar with this. Having enough money allows you to make it through the next season, get through the non-operating portion of the year. Have a sales problem, money allows you to get improvement to your product or service or hire more salespeople. The list is endless, and the point is money solves every problem in business. Now, money can come from a few more sectors, but these 3 sources are what I want to talk about. And so we have debt, owner investments, and from the business. So with debt, this could be credit cards, this could be bank loans, this could be, from your vendors that allow you to pay on credit and then pay later. Um, Owner investments, so this comes from your personal savings. It also could come from potentially selling stock of your business to help raise money. And then the third source is money coming from the business. This is money that the business creates. This is actually the best way to make money. From the business, it's basically going to be revenue less operating expenses, less your taxes, less your debt payments, less customers who didn't pay you, less vendor payments. In other words, it's all the cash that comes in, less all the cash that goes out. Whatever left over is what we're looking for. So to beat the survival rate, you must get good at making money. In all of the 3 ways, there's one clear winner. You must get good at making money from the business. Reason why, um, some debt's good if you use it to buy something that's going to give you a return on investment, but relying on it is just not sustainable. A business that relies on debts to survive would eventually go out of business. And the reality is the owner still must pay off all that debt. Also, a business cannot support itself and must rely on outside debt or investment, has either one or 2 things going on. So either there's a big chance this company is going to produce a lot of money down the road, or 2, the business just is not working and can't survive on its own. And most businesses fall into the second category. The bottom line is you must get good at making money. So question is, how do you do that? The answer lies into what I'm calling is turning your business into a money making machine. And so, what do I mean by this? It's doing what a machine is supposed to do. So, in this case, it's make money. If a machine is not doing what it's supposed to do, then, like all machines that are not functioning properly, you need to determine the root cause, right? And fix it. Also, your machine is running at peak performance and doing what it's supposed to do. So I'm going to give you an example here. So we'll just kind of talk about a basic washing machine. So its purpose is to wash clothes. It's made up of multiple parts. If it fails to really wash the clothes, there's a reason why. And if you find the reason and fix it, then your machine will get back to doing what it's supposed to do, which is wash the clothes. In other words, if the washing machine isn't washing the clothes properly or as good as it should, then there's always a reason why. Simply find the reason and fix it, right? It's not always simple though. But to do this, if you want your machine to do what it's supposed to do. It's the same thing with any business. Your business, it should be thought as a machine. Its purpose is to make money. It's made of multiple parts. If it's failing to do what it's supposed to do, there is a reason why, and you can find the reason and fix it, then the machine will get back to doing what it's supposed to do, which is make money. So, in other words, your business is not making money. There is a reason why. Simply find the reason and fix it. But only do this if you want your machine to do what it's supposed to do. And now this all sounds pretty basic, but it is it does have a theory to it here. So the good news is that like washing machine, every business is made up of the same parts. And each part has a hand in helping the machine do what it's supposed to do. And to get your business to make money, you need to get familiar with some of these parts of the business, so you can identify the spots or the parts that aren't working properly and do something about it. And we're going to talk more about these parts in just a few minutes. But first, I kind of want to go through and look at if your machine isn't functioning properly or at all. So if money isn't being generated from your machine and you can't pour your own money into it and you can't take on more debt, then eventually, worst case, it's going to go out of business and you'll have a business that will consistently struggle to grow at best. Either way, you or the machine's owner will be consistently stressed out, overworked, and underpaid. At the same time, most owners are afraid of their business failing for two reasons. So the first one is uh, they depend on their business working. Um, they have families to support, they have employees' families to support, and they put in so much time and money and investment into their business. Reason number two is they can't go back to getting a job. Um, Most business owners are typically unemployable. They also don't want to work for someone else again, and you tasted that freedom and being in control, and you don't want to lose it. So what happens, ironically, is most business owners own a job and they don't even realize it. So I'm going to talk a little bit about machine versus a job. So we talked about the machine. Now we're going to kind of go into a little more detail here. So most business owners are owning a job, and it turns out some of them are very stressful, low paying, and high demanding jobs. But most owners don't realize it until after they've started their business. In fact, most business owners start or buy a business because they want control, which is the opposite of a job. They want control over time, they want control of how much money they make. Um, Ironically, because most businesses struggle to do what they're supposed to do, the owner loses control of what they wanted in the first place. They must work more in the business because they can't afford not to, and they must work for less. So basically, effectively hourly rate goes down, potentially lower prices due to your competition, and most business owners start their business because they want control. They start it because they're also skilled at a craft. So, for example, HVAC tech starts an HVAC business, a dentist starts a dental practice, marketing expert starts a marketing firm, so on. And because of this, the business owner inadvertently starts a business that is more like a job they own. But unlike a job, there's no steady paycheck. There's no one to guide the owner. So in the absence of a paycheck, steady paycheck and guidance, the owner does what they know how to do best, is they rely on their skills, right? So again, HVAC spends most of their time doing HVAC things, dentist spends most of their time doing dental things, and so on. But the other functions of the machine will struggle. Things like getting clients, making sales, ensuring pricing is optimized, knowing what assets to buy, knowing when to expand, knowing if your marketing is producing a return, understanding the basic numbers, and there's so much more to it. And so the business struggles. The business struggles because the owner is wearing all the hats. And the business struggles because the owner who wants to practice their craft ends up having to do all the other things they don't necessarily like and are not necessarily good at. And it struggles because it's ran like a job and not a machine, especially not like a money making machine. So eventually their craft begins to suffer because the owner is overwhelmed and stressed. They bought themselves a very stressful, very expensive, and very low paying job. So, in fact, this is kind of a crazy stat. 86.3% of all business owners make less than 100,000 in a year. And if you're making less than 100 grand in a year, you're making way too little and taking on too much risk and spending too much time on what you might as well get a job at that point. For 100 grand, it's not worth it, at least my eyes. And most business owners are making less than that. The business owners have the worst of both worlds. They have a job without a steady paycheck, and they have a business without control that they really want. So, what's the solution? You own a machine, not a job. So, the solution is to turn your job into a machine, specifically into a money making machine. And like all machines, your money making machine is made up of multiple parts. And if it fails to do what it's supposed to do, then one or multiple parts of the business are not working at peak performance. So your job as the owner is to ensure that all these parts are working at peak performance. And now I'm just about to reveal the 16 parts that I want you guys to focus on. But first, let's just talk about this real quick. So you want a business that makes money so you can do three things. So take money out for personal use the money to grow your business, or use it to increase its value. So taking money out for personal use. So other than your control of time, making money is what most people really want from their business. You need a machine that allows you to take out as much as you want. You can use this money for a better lifestyle, go on vacation, pay off debt, send your kids to college, and so on. And then using your money to grow the business. So money, like we said, solves every problem in business, but it not only helps you stay in business, it helps you grow the business so you can reinvest in it. And then you can use it to increase its value. So most businesses are sold, eventually when people want to exit, usually on multiples of cash flow, typically between a 2x and a 4x. So basically, if you can make 100 grand on average, a lot of times you can sell it for 200 to 400,000. And if you want to sell your business at top dollar, you must increase the amount of money it creates. So as a recap, you want it to take money out for personal use. You want to use that money to grow their business and to increase its value. So now we can talk about how to turn your business into a machine. So these are the 16 parts of what I recommend everyone kind of looks at. So your job as the owner of the machine is to ensure each part of this machine is running at peak performance. Each part of this job is to increase one of these three areas. So you have revenue, it's what you sell, your profit, what you sell less your expenses, and your cash flow is what you keep. So increasing cash flow is more important than increasing profit, and profit is more important than increasing revenue. So here's an example. So last month, potentially you brought in $50,000 in revenue, and you had $30,000 in expenses. Your profit was $20,000. And after that, you had to pay for $4,000 towards debt or taxes, $3,000 in debts, and then you withdrew $6,000 for payments to the owner. And then you also did not get paid from a client for $12,000. So from a cash basis, you actually ended the month with a negative $5,000. So that money's got to come from somewhere, either more debt or owner investment or from the company's bank account. So as you can see, even though there's a profit of $20,000, that doesn't always equate to a positive cash flow. So your job as the owner is to get, revenue as high as possible. More importantly, is to get profit as high as possible. And even more important than that is to get cash flow as high as possible each month. Okay, so now we're going to go through kind of these are the three categories: revenue, profit, cash flow. And I'm going to go through the 16 parts that drive these areas. So under the revenue column, these are the parts that drive revenue. So leads. So this is kind of the number of ideal customers that have been made aware of you to purchase your product or service. The conversion rate, this is the percentage of leads that become paying customers. Retention rate, this is the percentage of customers who come back each year. And the purchase frequency rate is the number of times a customer, purchases in a year. And the average transaction value, this is the average value of every purchase a customer makes. So I have a little Excel sheet we'll show you in a few slides, but how this all equates to revenue. But a big component of these is you do need to be tracking this information. And if you don't have that information, if you're kind of just riding on the seat of your pants, it's really hard to know where you're at or where you've been or where you can go, because it's very challenging to make adjustments or change within the business. So my recommendation is, if you don't have this information, then you need to figure out how to get it, and hopefully potentially can go back in time a little bit and figure out where there's potential, positive spots and potential negative spots. Okay, so on to the profit piece. So cost of goods, we always kind of look at this as a percentage of revenue. And this is how much it costs to produce the goods or service for each sales transaction. Marketing expenses, this is your total cost of marketing. And this should be looked at as a percentage of revenue as well. And then payroll expenses, this is the total amount of payroll that's not included in cost of goods. So this would be like back office support, maybe manager wages, things like that. And then overhead expenses, these are all the other operational expenses like rent, insurance, and so on. And then you have other income expenses. This could be like, you know, financing activities. It could be from insurance payouts, things like that. Non-operational income or expense. And then onto the cash flow. So these are major major drivers for cash flow. So days sales outstanding. So this is the number of days it takes to collect from a customer. So this could vary from business to business. So like retail sales, it's pretty much instantaneous. But if you think of, maybe someone that builds a home, like that could be 200 and some days until you actually receive cash for a sale. So it does vary a lot from business to business. Days inventory outstanding. So this is the number of days it takes you to sell your inventory. So basically you pay cash to buy that inventory, sits on the shelf, and how many days later does it actually create a sale and collect cash back? Um, Sale or purchase of assets. So potentially buying a truck or machinery, that increases cash flow. Selling it and then purchasing assets will be decreasing your cash flow. Days payable outstanding. This is the number of days it takes you to pay your customers. So the longer it takes you to pay your customers, the more cash you'll have on hand until you actually make that payment. And then using or paying down debts. Taking on more debt will increase your cash flow, but when you pay it down, that does decrease it. And then the final one is owner investments or distributions. So investing your own money is going to be increasing your cash flow, and then taking on distributions will decrease your cash flow. So these are kind of the main drivers of every business. And from like the financial aspects of any business, there's a lot more categories. There's a lot more things you can look at. But to get a good handle on your business, it's better to kind of summarize it and look at it in this fashion. It's very easy to get kind of lost in the weeds, I would say. And so when you break it down to this summarized level, it does help to highlight certain areas that are performing well and certain areas that need attention. And so if you're able to improve one part, assuming all parts are the same, you'll see an improvement in your business. And if you're able to improve two or more parts, you'll see a dramatic improvement in your business. And imagine if you can improve all 16 parts, right? That would be best case scenario. Okay. And your business will become a money-making machine beyond your imagination. And this is how you're able to transform your business. So I'm going to give you an example here. Hopefully you guys can see this okay. Um, in here, this is the revenue drivers. And I just wanted to kind of illustrate an example of what potential impacts your business could be on addressing certain drivers. And so if you look at this first column here that says last year, you see we have the five different drivers for revenue. And it looks like we're leads, about 1,000 leads last year at a conversion rate of 10%. So that drew on 100 new customers. And then past customers were 500 of last year, and we were able to retain 5% of those. So those are 25 retained customers, and that equates to a total of 125 customers this year. And the frequency rate of purchases is a 2. So basically, we have 250 total transactions for the year, and our average purchase value is 1,250. So our revenue last year was 312,500. And so, for example, if we wanted to make some positive change within this business, we could look at each one of these five drivers. But for example, we had a strategy to focus on increasing our leads, and if we attempt to get 1,250, so 250 more leads this year, with the same conversion rate, the same retention rate, and the same purchase frequency rate, and the same average purchase value, you can see the bottom line goes from 312,500 to now 375,000. So that was a huge impact with all other things being the same. And the next column over is an example of the change in the purchase value. And so all things being the same, we changed our purchase value from 1250 for average value to 1500. And we still only had 1,000 leads, which was the same as last year. So again, we were able to increase our total revenue up to 375,000. And so you kind of look at these, and there's a couple other ways to look at it. So with the change in the purchase value, potentially was it just a price increase? If so, that had a huge impact for much less amount of effort in the business, right? But will that prices sustain? What does that do to your competition? Those are all kind of things you have to think through. But you can see it has such a dramatic impact. I mean, there's another situation, potentially you're bundling products and offering a little bit of discounts, but you're increasing that potential value. And so it has a huge impact. And then the last column, it shows an example of we're focusing on increasing leads to that 1250 and the purchase value of 1500. That goes from 312,000 the prior year to 450,000. So huge impact there. So on every business is going to be different. So but if you're unable to understand where your drivers are at and where you want them to be, it's very difficult to make those changes. So again, kind of going back to if you're not tracking leads, like you definitely need to start. And leads can come from a bunch of different sources. It could be foot traffic in your store. It could be website traffic. It could be what your outreach is with your sales team. It could be referral clients, anything of that nature. And like I said, it's just you have to have that information or start gathering it and moving forward. And there's lots of tools out there with CRM software. There's potentially pen and paper. If you're online, there's Google Analytics that's super helpful. So the resources are there. Okay, this looks a
Those are
little.
added for accessibility, just so you know. You
Okay,
can,
I was like, I don't. Oh, so that's. Thank you for clarifying that. Okay, I'm gonna skip through this. Okay, so kind of moving over to the profit drivers. So we have 5 drivers over here. Um, we have the revenue, we have cost of sales, payroll expenses, marketing expenses, overhead. So here's another prime example. Last year, we were at about 86,500 profit. And with all things the same, this year we decided to change our percentage of cost sales from 60% to 55%. And so in this specific business, let's just say it was a construction business, and we were able to source out different vendors for building supplies, and we were able to create that cost savings. And so what that did for us was changed our profit from 86,000 to 102,000. So a decent impact, basically reaching out, doing research, and finding better vendors for our materials. And this could go from maybe cost of sales could be direct labor, and you're able to create some efficiencies within how they how they're doing their processes. Maybe you find out quicker ways to do it. Like the way you dive into it is going to be specific to your business. But if you realize your cost of sales are going up and up and up, it's definitely a red flag, something you need to look at and start identifying what's going into that number. Why is it going up? Maybe that's the reality of it, and we need to focus on our pricing. Um, it goes on and on. But another example is a change in overhead, and so we were able to find a a different, let's just say we found a different office building, cheaper rent, and we're able to save about 5,000 last year. And so net profit goes up to 91,500, which is a nice improvement from the prior year. And then another example is when we focus on both of those drivers, we're able to really have a good impact on the net profit of this business. Okay. And we got the same breakdown here. Okay, so this is the cash flow drivers here. So it kind of starts off with just your profit from the prior screen. And last year, we were able to increase our accounts receivable balance from, looks like we increased it $500. So that's cash that was out of the business, but then we collected on $2,500 of existing accounts receivable. So that increases our cash by 2,500. This business doesn't have any inventory, but we decided to, last year we purchased 20,000 in assets, but we sold 30, and then we took out 35,000 in debt, and we also paid down 35,000 in debt. And then the owner took out 95,000. And so the cash flow for this year is increase of 3,500. So pretty flat. So I think, the owner is probably just trying to keep the cash as is and taking out what they could. And looking at this year's target, all things the same, but the owner did not want to take out additional debt of 35,000. And so that did, have a negative impact on the business, and the cash flow was negative 31,500. And so kind of having this planned out, the owner could have potentially done a few different things to help the business be more financially stable. One is they could have made the decision to just use up some of those reserves to keep his pay as is and be okay with it. But potentially the owner could have withdrawn less money from the business. Potentially they could have not have purchased 20 grand in new assets this year. And, if those different drivers aren't adding up to what the business owner is looking for, then they have to go back to the profit drivers or the revenue drivers. But on some businesses, if you think about like potentially like a lawyer, and they rack up quite a bit of revenue, but they're not getting paid for a lot of these services until like the trials ended. And so they're having some issues with cash flow because they're not collecting on their accounts receivable. And this could be, with a retail business, anything like that. So there's different strategies you can do to help manage that cash flow. It could be changing payment terms. Maybe you go from making it a positive 50% up front and 50% at the end. There's different strategies to help your business survive in those situations if cash flow is like if it fluctuates so much. And throughout these drivers, your specific business are going to have more important ones than others. And so these are the things that you should be really looked at, because when you look at your profit and loss statement, it doesn't necessarily show these numbers and how it impacts your cash flow, because you might have let's just say, a profit of 100 grand, but things that aren't showing on it is the owner's withdrawal potentially, or the debt payments, because your interest will show up, but the actual debt payments don't. It could be capital expenditures, things like that. And here we are with the visuals. So transforming your business. So in a nutshell, to have a growing and successful business, you must turn your business into a money-making machine. And to have a business that doesn't fail, you must turn it. It's a repeat there. To have your business that gives you back the control that you want, time and money, you must have a business that's a money-making machine. So kind of driving that home here. However, although money making is the point, it's not to do easy to do. It's not easy to do because most business owners are not necessarily numbers people. And money, cash flow, and the 60th part of the business are all numbers. Most business owners understand that they need to know their numbers, but they're not exactly excited about poring over data to understand their parts and determine which ones need improving. But I am. And I'm a financial professional who works exclusively with small to medium-sized business owners. And I do one thing well is I help transform businesses into money-making machines. And I'm very passionate about it. And so is my little plug here is if you would like to explore new ways to strengthen your business, let's connect for a short conversation. We can get on a quick call, learn more about each other, discuss your goals, and see if my approach could be helpful for you. From there, I could outline strategies, make some recommendations, and provide a quote for my services and answer any questions you may have. And so if you'd like to schedule a call or an email, my contact information is below. Okay. And time for questions at this point.
Well, we'll open it up to questions, but I
Okay.
wanted to say first, Billy, thank you so very much. And also say that the Colorado SBDC network is here to help you with various aspects of your business as well. So you have many resources today, and we really do want to support you. And with that, I'm going to stop recording so that you can start asking your questions.